Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Hi everybody, welcome back to another recording of Show Me the Money Live, and that's hosted by myself, Sharma, a London-based property investor and developer, and once again joined by the delightful
Marc, owner of Wolf Financial, property investor, and full-time dad and gym goer as well.
That's good. Healthy body, healthy mind. I've been getting into the personal training as well, actually, which is a really, really good thing to do. Helps you with the emotional ups and downs of property and dealing with that. So we've obviously been doing a few of these recordings now. We've got this new format, which is broadcasting live. And we like to try and cover a variety of topics, all things to do with finance. Myself, obviously, from giving a perspective from an investor, developer point of view, and Marc, obviously you've got that insight as an intermediary with your background in finance as well. So the sorts of things I thought would be good to talk about today. It's a free-flowing conversation, building upon what we've discussed previously. I guess is one of the things a lot of people ask me is the value of using an intermediary or a brokerage versus going directly to lenders. And I think it's quite an interesting topic because I have to say, I do a bit of the two, but it's not something that suits everyone. What, in your experience, is it that makes it important for investors and borrowers to consider using an intermediary, and why?
Yeah, it's a good question, and it's something that we're asked to justify all the time. Why are we deserving of a fee? And it was interesting also, I messaged you last night about the AI tool that I had found, and this AI tool, it summarises any text you put in, and it can also summarise websites. And I actually put in my website, Wolf Financial, and it gave me a summary of the pros and cons of using Wolf Financial. So it was actually very, very interesting to see that there were lots of pros it found about why using a broker who have ex-bankers there will be able to get behind the normal front line of defence of a lender, and also understand the jargon and be able to translate it, all those sorts of things. And it's not until you actually use a broker when you'll actually find their use, because what it looks like on the surface is you ask a broker to find you a deal, they put it into an application process, and then at the other end a loan comes out. But there's a lot of things that go on in the background that I suppose the customer doesn't usually see. And I think it starts firstly with making sure that the deal stacks up, getting a second pair of eyes on it, and that's invaluable. If you go into any transaction that you're not going to make a profit, or it's not the right thing, sometimes you're led by emotion, and the broker can actually say to you, look, this isn't a good deal, or you've missed this, or you need to consider this. So that's a good start point. Then having to trawl through all the lenders. There are countless lenders out there, especially in the bridging finance side of things. It's really important that you pick the right lender, and it's not only the rate that is something that you need to bear in mind. It's the default rates, it's the speed of drawdown, all those sorts of things that come into play that the broker should know, or certainly investigate, and then be able to come back and give you the answers. So there's a long list of reasons to use brokers, and I think it's not until, like I said earlier, until you actually use a broker and go through that process, you'll see the value that they add along the way. And so it can be quite expensive, but if you get the right one who's charging the right fees, then it can save you money in the long run. So, what
Yeah.
was your experience with and without a broker then, Ray?
Yeah, and I think, and that's a really good update. I think it makes a lot of sense. I mean, a couple of things you said there, which really kind of resonate with me. It's very easy as an investor to slip into that difficult area of being a motivated buyer, especially when you've got not a great deal flow or not a great pipeline, or there's not so many opportunities in the market at that particular time. And sometimes we do, and I've been in this position myself. You become emotionally attached to a particular deal for a variety of reasons, but it just might not work. And you do need an independent person to tell you that. And I think having an intermediary who's used to seeing those sorts of deals and knows what lender appetites are can be really instrumental. I think another thing as well is that we get used to stacking and evaluating deals in our own way, using our own model, our own spreadsheet, but actually having somebody who can look at it, who's seen hundreds, if not more, of different types of deals and how they're stacked and what needs to be factored in. That's obviously something you get with an intermediary who can tell you what else you're missing or what else you need to include in that deal stacking spreadsheet as well, and then you can help kind of see for yourself whether or not it works. So having that first glance or first line of defence, that first lens for somebody to look through your deal is really important. I personally have gone directly to lenders in the past, and that has been off the back of building relationships with senior people or underwriters within that lending institution or within that bridging and development finance lender, because that helps me to also kind of get a sense of what sort of deals they like and whether they like that sort of proposition, and also for me to understand what their particular limits are, because I think it's also as much about the rates and the terms as it is the relationship, because I've found on a number of occasions if things haven't quite gone to plan or aren't quite going the way they are that you anticipate from the beginning, having that relationship with a lender really helps, especially when you might be running behind schedule or there might be a complication that has come up halfway through the build or whatever it is. So, because there are some lenders out there, if you've not done your homework, you could end up in quite hot water if things don't go to plan. So that's why I like to understand their appetite, and it helps me just to fix situations when there is an issue to resolve. But the benefit of using an intermediary, obviously, is that they know and they also have those relationships at the underwriting as well as the business development level of those lenders, so they can help you to understand what their appetites are and where it works. So there's been times when I've actually needed to work with a new lender who I didn't have a relationship with, and that's obviously where the role of a broker or intermediary is invaluable. And yep, you're right, we do have to pay a fee for using a broker. But actually, I've never regretted that, because they've always given me, especially if you're working with the right broker, have always given me some invaluable advice and opened up new pathways with new lenders that I might not have considered otherwise.
Yeah, definitely. And these relationships that we build with lenders have been built over a number of years. If you've got an experienced broker, for instance, I've recently completed a large transaction, and this transaction, I suppose, it's been about 10 years in the making, I would say, because not only has my customer been with me for 6 years, but my relationship with the person handling the transaction at the lender is about 10 years old. And it wouldn't have been for that... if we hadn't had that relationship, the deal wouldn't have gone ahead, and it's saved the customer so much money. It's a large deal, up at £13 million. So it's saved the customer huge amounts of interest. It's got them into a bank where they're going to be looked after well. And usually they would just go to a high street bank for this type of loan, but instead we've gone slightly off the high street, and we've come up with a solution which not only saves them money but gives them a relationship which potentially they wouldn't have at one of the high street lenders, because as we know, relationship managers are overstretched and they are under-resourced there. So it's really important that you understand where the value is, and the broker taps into that, and it goes out to find where the value is. And it's not always in the rate. It can be in a number of different areas. It's really, really important that everybody looks at the whole bigger picture. And another thing people fail to do, what we've seen in property investors, especially new people coming in, they come in and say, I want to buy this house and turn it into X, Y, and Z. They're not saying, I want to generate X amount of wealth and have a strategic plan about how they get to that position. It is just like finger up in the air. I want to buy this because it looks like it could be turned into an HMO. But it's not always that simple. The overall plan is something, and we bring in different professionals to work with our customers if that's what they need and what they want. And it really does set us apart from, I suppose, our competitors.
What sort of things do you do with your clients or customers to help them position themselves better, especially for the more, I guess, people who are at the beginning of their journey? Because, as you say, there's a lot of people who will see stuff on social media or they'll attend courses, and every house they look at will be a potential HMO, which may not necessarily be the right strategy for that investor or for that building or for that location for a variety of reasons, whether it be planning, market values, demand for rental accommodation, etc. But what sort of things do you do with your borrowers to help them present their case in the best way, other than just the spreadsheet and the facts and figures on the building itself?
Do you know, I went on a course recently and I came up with an acronym of things we were doing to help our customers. And I'm trying to think back. I know the acronym was VIPER, and it was vision. So understand what the customer's vision is, and understand where they want to be, and how they where they see themselves in, say, 10 years. And so that's really, really important. What was I? I can't remember, and I don't know where I've written it down. I was something. Can't have been that good an acronym. P was. I need to find this. Ask me another question while I find this. Right?
This is good. I can guess what the letters might be, but let's wait for you to do that.
Yeah.
No, because I think you're right. It's got to be the whole package. It's not just about the deal. It's you as an individual. What's your strategy? How are you funded? What's your kind of the finances and the background? What's your experience? And one thing a lot of people underplay is, especially when they're new to property, is their previous experience. You know, for example, I was a project and program manager amongst many other things when I was working in banking and finance. And actually, when I went into property, those sort of skills are really, really really, really good experience, because it gives you the opportunity to build teams that are effective. You know how to manage risks. You know how to kind of keep a project or a program on track, albeit building or refurbishment works being slightly different kettle of fish to big change in a banking institution. But at least knowing those tools and how to use those, or your ability to sell or to build. Bring teams together, build relationships, and get difficult tasks over the line. All really, really important, no matter what sector you're in. So, talking about yourself is a key thing.
It is, and you do need to do that. It's really important. And I found the acronym. I've got it written down. So
Brilliant.
The first one, like I said, was the vision. It's telling your story, making sure you are there and promoting yourself, and so people understand where you want to get to in the long run. Really important to do. The next one was identity, and that may sound a bit of a strange one, but banks want to see who the person is, what their identity is. And I'm not talking about looking at their passport, I'm talking about their brand. They want to be able to go on a website, see a professional website. They want to see a professional type investor who they know is not some cowboy out there who doesn't have a track record and doesn't have a clue what they're doing. So creating that identity and their own brand is really important.
I like that.
The next one was the process, just making sure that customers understand the process. And we've done that by creating our ebook, the Guide to Property Finance, which is free on our website. People can download that. Just go on it, pop-up comes up, you can download it for free. And that process has so many different things. It's always evolving, and the actual terminology is something that can trip people up. When people are talking about letters of non-crystallisation and deed of priorities and all these sorts of things. So we created a glossary at the back of our guide, which tries to explain the acronyms. Like CHAPS payment, which is clearinghouse automated payment system that most people in lending probably don't know themselves. And it's these sorts of things that we try and make there and easy for customers to understand. Education, with the education part of it, that is about keep teaching yourself different techniques, learning from other people, and educating yourself with all the trends that are happening, and also not always listening to what a training company is telling you. Training companies are decent in my opinion, and they give a lot of information out, but there is more to it than just going on a course. There's invaluable things you'll learn actually educating yourself throughout the process. And then the R of Viper was risk. Risk is something that I think has gone out the window a little bit. I think people haven't really learnt their lessons so much from 2008. I think we're seeing so many people, especially on social media, that are talking about, right, I want to borrow as much as I can from a lender, and I'm going to borrow my deposit as well from an investor. And invariably, if anything moves in the transaction negatively, you're going to be in a really difficult position. So understanding risk, understanding what level of risk you can afford, and understanding what risk any potential lender is willing to afford you. Because there's some lenders that will be a bit more lenient than others. For instance, Together Money, they have a really important place in the market. However, if you go a day over their term, they invariably will charge you a fee for that, and it's quite a sizable fee. So there's lots of things to bear in mind, and I created that little acronym Viper, and it sort of does bring in a lot of aspects that people don't think about. And I think soon there is a real need out there for understanding property finance, because it is such a minefield. It's such a place that's ever moving, ever changing. And if you don't have a professional keeping on top of it, you will make mistakes. Yeah. And, a broker can make a mistake, but they're very probably less likely to if they have been around the game for a lot longer and understood things and understood how the mechanisms work and understand how the chain reaction happens. So, for instance, what we get a lot of the time is, right, customer comes to us, says, we want to buy a terrace house, turn it into an HMO. Can you get me the highest loan to cost out there? And we say, okay, yeah, that's fine. If a customer just went, a naive customer, shall I say, went straight to a lender and got that, they would see a figure of the gross loan. And that would then be filled with a lot of other lines on their terms. The gross loan could look great, but some lenders will take off interest from that. They'll take off their fees from that. They'll take off legal fees from that, QS fees from that. an admin fee from that, and you're left with a net loan position. And it sounds really easy to just say gross loan minus these things equal net loan, but there are a lot of lines there, and the lender's terms are all different. So you could get a term sheet from Octane, you could get a term sheet from Funding 365, you could get one from Roma, you could get one from Together. They're all different and they all have different lines. So it's about interpreting that for a lender, for a customer. And what we try and do for our customers now is, and this is only something we've introduced recently, is we've tried to, when we go out to lenders, we've tried to get 3 different options for them on different structures, but then translate it into one set of terms which is uniform all the way through. So you can see all 3 lenders, but they've got all the lines the same, so that you can understand what is going to be. You can compare apples with apples rather than apple, pear, banana. And the actual thing we do for our customers, like I was getting on to say, we do an interest retained option. So the interest is taken off the day one loan straight away. We do a part retained, part rolled. So that means some of the interest is taken off of the day one loan, and then some of it is added to the end loan when you pay it back. And then we do one which is completely rolled, so all the interest is added to the end loan amount. And what that will do is it will give you different loan amounts that you're going to get on day one, and how much deposit you will need is going to change. So we then translate that for the customer so that they can see exactly the different types of lending available and help them interpret that. Because if you were a customer, you wouldn't necessarily know which bridging lenders are going to do interest rolled, which are going to do interest retained, which are going to do part and part. So you would go to one and you would say, right, let's do this deal. You would get an interest retained, and your net loan position would be at 60% loan to value on day one. But I know with an interest rolled, you could potentially get up to 75% on day one because the interest is being added at the end. So these are the things that a customer wouldn't necessarily know. And then we can go back to the R of the Viper and the risk, because obviously if it's interest rolled, you've got to think about the exit. And if you roll the exit, roll the interest, your exit is going to be harder to get out with. So you then need to think about the knock-on effect of that and an HMO. So if the bridging lender has been valuing your GDV, so your post-works figure, on an investment value, but all the HMO long-term lenders are going to value it on a bricks and mortar basis, then you've got a very different figure probably. And you're going to be stuck. So these are the things that without a broker you wouldn't necessarily know how to join up the initial application or the initial inquiry about interest to your exit and long-term stability in your portfolio.
I really like that. That's a brilliant explanation, because recently, and again, because I come from a banking and finance background, I go really deep into the numbers. And actually, as you said, no term sheets are ever comparable from different lenders. And I think that's quite deliberate as well, because they don't want you to be comparing them with each other. So the ability to deconstruct them so that you can compare them apples to apples is brilliant. I've actually done that myself personally recently, because I had a couple of direct relationships with a few lenders. And actually, when I looked at the net loan on day one, that was something that was very much driving my decision about which lender I was going to go with. However, on the flip side, if we just ignore the interest rates for a moment, when you looked at the gross loan, which is the total amount that's going to have to be paid back once the project was complete, there was a significant difference between them. even though the net loan might only have been a difference of 10, 20k or something like that. So I might have needed 10 or 20k less to buy the building, but actually it was going to cost me about another 40 or 50k at the back end, which is quite significant. So it's really important to understand what that gross loan amount is, because that's what you're going to have to pay back, and you don't want to be dipping into your pocket to do that in 12 months' time.
And you also need to consider how the interest is charged, whether it's
Exactly.
compounded interest or not compounded interest. Because if it's compounded, you get interest on interest on interest on interest, and that interest figure is a lot higher than non-compounded interest. So it's something that should be a question to ask. I've never been asked that question by a borrower because they don't know. They wouldn't necessarily think of that as a question. The other thing is, I've never been asked on a bridging refurb loan, and I'm trying to think if I have or not. I don't think I have. Whether there's the security will include a debenture or a personal guarantee. Developers have asked me about personal guarantees because they always, we don't want to pay a personal guarantee, and then we say, well, you're going to probably have to pay between 15 and 25% personal guarantee. But invariably, we never get asked about the security package, and it's important because with a debenture, you would generally be all the assets within the company, and presuming it's an SPV, you wouldn't necessarily have any assets in the company, but one of the assets in the company as you go along could be a increase in cash because of rents building up, and you're keeping hold of that. So as part of the debenture, I would presume that is classed as an asset, and you would be liable to pay that in a position if you ever got yourself in trouble. So it's something to actually think about. What security am I actually putting forward here, and am I able to pay it if the worst does happen?
And it's important for everyone to understand who's listening in as well, the difference between these different types of security. So a personal guarantee is just you underwriting effectively that loan and guaranteeing personally that it will be paid back. And I don't think I've ever been involved in a loan where a personal guarantee wasn't required. For most of my loans, they've always been, and when I say loans, I'm talking about bridging, development finance and mortgages, personal guarantees have always been uncapped as well. Or I say uncapped, they're uncapped. They're capped only at the loan amount, but they're not sort of limited. And I know, as you say, some lenders will allow like a 25% or 50%.
I'll stop you there, Ro. Some are uncapped.
Okay, that's good to know.
You need to check it because some are uncapped, and if you are in a position where you owe more than you can pay out through the property sale or whatever it may be, you're on the line for that, and some are uncapped. Most of the time, they're 100% guarantee. But again, 100% guarantee, if you think about that, when you're looking at security, it goes in an order. So they'll look for the property first and foremost, then they'll look to the assets of the business, then they will look to the person. But for some reason, if the property wasn't available as security anymore, or the value had dropped massively, you are still on the line for 100% of that loan. So it's something that is important, and lenders don't really talk about it too much. They don't come out and say
they don't want to scare you.
No,
you've got the
they
costs
come
on
out
top of
and
that as
say
well,
we've
right?
got a headline rate, but they never come out and say we're dropping debentures and personal guarantees. They don't do that, and it would be a unique selling point because mainly they all have the same security package, and the reason for that is a lot of them are all funded by the same people anyway, just with a different badge on it. So it is really something that you should look out for, and you should be doing. And these are the things about property finance and brokerages that I think are overlooked. The expertise at the brokerage is going to give you a different level of insight if you want it. A lot of
Yep.
people aren't interested. They just want to do the deal and get it
Yeah.
done as quickly as possible, and that's it. But it's something that is very important.
I guess the ability to negotiate those down as well, or to cap them, or even out of the conversation,
Yeah,
is
the
something
personal
that helps an
guarantees.
intermediary for.
The personal guarantee is a difficult one because if somebody comes and says we don't want to we don't want to put a personal guarantee forward, the first thing a bank or a lender will say is, "Why not? Don't you back yourselves?"
Yeah,
And it
exactly.
happens.
Yeah.
That question is the default question, and yeah, it's not an easy question to answer because
Yeah.
invariably you don't.
Yeah.
But it's something to definitely think about.
No, that makes a lot of sense. And as you say, you have to back yourself because otherwise, why should they? Two other things which I think are really interesting, which you talked about, is understanding the interest calculation. Because I know even for myself as a borrower, historically, I've looked at the headline rate and thought, that's kind of guided my decision making. But it's very much about that interest calculation and what is the total amount of interest that's been added into that gross loan amount.
And that's
It's a really
not
important
always
question.
correct. So the figure that you get as the interest deducted, they can predict how much it will be on day one,
Yeah,
but they can't predict how much it's going to be in the development phase or the refurb
Yeah.
phase, because that's going to be moving. You don't know when you're going to draw down. You don't know
Yeah.
how much you're going to draw down. So you don't know how much interest you're going to be paying. So it's something that you're not able to predict.
Yeah.
So some lenders can put a whole lot of interest, or they can do a sort of calculation to show probably about what it will be. And some people could, lowball it so it looks like you're going to get more loan. And I'm not saying lenders will do that, because all the lenders I work with act responsibly and they're doing the best they can for the customer as well. So
Yep.
it's something that needs to be looked at. And there's a lot of things when assessing a loan. It's not just looking at the rate, as we said. There's a lot of things, and it takes a lot of time. And it takes a lot of my day going through all the lenders and choosing the right ones for my customers. So yeah, lots of things that we could talk about and just go into wormholes.
Indeed. And I think actually it's a good point about the refurbishment bit. It is always an estimate. And I guess a question that we should always have in the back of our minds, which obviously working with a broker or intermediary, you will ask these questions anyway. But for us as borrowers, when thinking about what is the method of calculation for the interest for the refurbishment, and the reason for that is because they might just choose a straight line based on, let's say you've got let's call it a 5-month project. It's going to cost you, let's say, let's call it 500k, right? You might be drawing down 100k a month. They might be calculating your interest based on 100k a month. However, in reality, the build might be an S-curve distribution where perhaps there's going to be a much higher or much lower amount of drawdown at the beginning, and at the end it's going to be much higher as well. So actually, it might be that you need 200k up front, and then it's 50k, and then 200k at the back end, and obviously that's going to look a lot different to how it'd be if it was just a straight line 100k a month. So that changes your interest calculation. That's a good point. The other thing I just wanted to pick up on was debentures, just for the benefit of our audience. Could you just explain what a debenture is?
Do you know what? When I first started lending, I got tripped up on this because I never knew what a debenture was. And I remember we used to have tests and things we used to do at NatWest. And I think I was doing my banking exams, and I can remember not knowing what a debenture was, but it's quite simple really. It's a charge over the assets of a company. So whatever assets sit in that company, you as a lender, if you need to, can take them in a position of default. So if you've got tangible assets in there, if you've got other things that are owed to you, so if you've got, for instance, people owing you money, you can potentially go after those people and get some of the money back from the people that owe you. So it's a charge over the assets of a company. You don't necessarily have that much to worry about from a property or a UK limited company SPV, because there's not a lot in there. like I said earlier, the rent is something to have a look at. But other than that, you're not usually owed money by people. You don't have trade debtors. You don't have debtors that a lender could look at. And I think Shawbrook have dropped their debenture requirement. I'm pretty sure they have, because it's a little bit pointless in a property SPV type of transaction. But what I would always suggest, and I don't know if I'm right or wrong to suggest this, is if you are lending money yourself, you should always take a charge over the rental income. So not only do you take a charge over the property, but you take a charge over any rental income that is due or becomes due, because then you can control the asset. And that's only if you're lending money to people. But make sure you're...
Would that be through a debenture specifically then, or would that be an alternative form of charge? How would you secure that as an investor?
As well, so if you were investing in somebody's project, lending them money, you can just have any charge written in. You need legal wording to say a charge over all rental income due or whatever it may be, and then if you are in a position where somebody's not paying you back, you can automatically take that rental income.
It's a good tip.
Yeah, maybe just go on ChatGPT and type it in.
Yeah, that's good. That's a good idea. So there's been some great content here. Obviously, make sure we stick a link to the Wharf glossary as well, then, because I think a lot of people do get tripped up on these terms in terms of understanding what the impact of them is. But if you know your language when you're talking to the lenders, when it goes to the actual application stage and you've got all those documents to sign as you're going through the legal process, it helps to understand this stuff, because it doesn't get explained very well by a lot of people.
And do you know, last week we had the most people download our guide to property finance we ever had. It was a lot more than we usually get, and I don't know if people are just getting tripped up more or they want to know more, but yeah, we had more than ever download it, so it was really encouraging to see.
That's good. Well, I look forward to taking a look. Let's talk about networking for a couple of minutes. What's been going on the networking scene? What have you been involved in?
What have I been involved in? So PPM Brentwood, actively part of that. We're growing the group. We have around 30 there each month. Really good little group. Some really good speakers actually that we have along, talking about different strategies and different ways of making your money in property. I'm going to be at the Brendan's event.
Yes, I saw that.
Finance update, making my debut there. So just a 5-minute update on the economy. Where else? Lots of golf networking has been good. I think everybody's been trying to get golf in before the weather turns. So that's been good. We've booked up the flights for Cannes for MIPIM next year. So the large property festival in France, that's all booked up, ready to go. And that's been about it really. But always open to coming talking at events and presenting, doing little economic updates on property. So yeah, lots
very
going
good.
on.
No, and you can't ever underestimate the importance of networking. I attribute a lot of my sort of achievement of goals and success with doing that. The relationships I've built. Obviously, you and I met out in Cannes, courtesy of Brendan Quinn as well. Actually, so a big shout out to him. That's led to some great things. Actually, I've been also doing some work with Brendan at his events and sharing some of the panel discussions. So we did one earlier in the summer on creative deal structures and joint ventures and what collaborations look like. And I chaired the September meet at the Central London Property Network as well at London Bridge. So it'd be good to see you at the next one. That's really good. I've also been doing a bit of networking with some lenders directly. So I was at a lunch with UTB, United Trust Bank, just 2 weeks ago, which was a fantastic event as part of their Wise Owl series. It's just a great opportunity to get to know people within the lender development team and other investors, developers. There's some good collaboration opportunities that come out of those meetings and networks, and obviously just increasing your understanding and knowledge of the market. So definitely recommend that to those of you who are out there who aren't perhaps making as much of the networking events that you have. Just today, in fact, I was with Lend Invest as well. Had a session there with the underwriting team and the CEO as well. Just great opportunity to actually just understand a little bit more about their lending criteria and their appetite for particular types of deals. So just getting out there is really important, because you just never know where those relationships are going to come in when you've got a particular deal that you need a bit of help with. So that's definitely good advice, and I need to book my flights for MIPIM as well. I've been given the all clear for that. So flights and accommodation, hopefully I'll try and book those a bit earlier this time round.
Yes, definitely. Yeah, I always get mine in early.
Well worth it. Well, I guess that's probably that's it for today, right? I think we're going to have plenty more of these. We'll have these on a weekly basis. If you've got any questions for either Marc or myself, please do send them before. Any topics you want us to cover, and we'll be delighted to answer those, along with some of our guests, because we've got some great guests lined up for the future sessions as well.
Good. Thank you very much for listening, everybody, and we will see you soon.
See you soon.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.